Hello. Today we are going to talk about something interesting, linear forecasting. And what does that mean? And why should CFOs know about that? Now, early in my career, I watched a CFO present a forecast to the board. Now, he had built this incredibly complex model with dozens of variables, fancy algorithms, statistical techniques that I've never heard of. That's fine. And the board was a bit confused, and one director finally said, okay, so can you just tell me in simple terms, where you think revenue is going and why? That's what the CFO stumbled. He could not explain it simply because he didn't really understand what the model was doing. So here's what I learned that day, okay? Forecasting is not about complexity. It's about understanding the patterns and being able to explain those patterns very clearly. And the most fundamental pattern, the one you need to understand before anything else, is the straight line, linear forecasting. I know it sounds really basic, okay? I've seen companies with a lot of valuations gone wrong because they were getting into data that in a manner that was not convivial for the right valuations. So in this video, we're going to talk a little bit more detail about linear forecasting, what it is, when to use it, and how to do it right. Now, there are arguments against linear forecasting, by the way, and we can talk about it in a separate video session when we're talking about exponential growth and that forecasting might not work for that. But let me start off with the basics, okay? So what does linear actually mean? Linear means a straight line. When something is growing linearly, it grows by the same amount each period. So let me start with a simple example. Say your revenue is 100,000 in January, in February is 110,000, in March is 120, in April is 130. You see the pattern, you're just adding $10,000 every month. Now that is linear growth and the increase is constant, 10K, 10K, 10K. So if I asked you to forecast May, then you know it will be 140,000 and June will be 150 and so on and so forth. All you're doing is you're just extending the line. And that is linear forecasting in the most base, crude, simplest form. You identify a constant rate of change and you project it forward. Now here's the math behind it, don't worry, it's really simple. A linear relationship can be written as y equal to a plus bx. Y is a dependent variable. This is what you're trying to predict. Let's say revenue. X is a time, month 2, month 3, and A is your starting point where you begin. B is a slope, how much you add each period. So in my example, a $90,000, well, let's say the starting point before month 1, and B is $10,000. So for month 5, it will be 90,000 plus 10,000 times 5, that's 50, so $140,000. That's it, that's linear forecasting. Simple regression model. You find the starting point, you find the slope, and you extend the line. And when does it work? When should you use actual linear forecasting? And when should you not? Linear forecasting, they work well in a very few situations, a very few set of situations, but it does work. It's not that it doesn't work. When you're in a stable, mature business, if you've been growing by roughly the same amount each quarter for years, linear forecasting generally makes sense. You're not expecting anything dramatic to change. Second, for short-term forecasts, the shorter your forecast horizon, the safer your linear assumptions become. Predicting next month based on a linear trend is usually more reasonable than predicting 3 years out. That is way more risky. Third, when you're adding capacity in steady increments, say you're hiring one salesperson per month, and each salesperson, they're adding, let's say, $50,000 in revenue, that becomes kind of like a linear relationship, isn't it? More reps, more revenue is kind of straight line linear forecasting. Fourth, for cost forecasting, where costs are scaling proportionally, if your cloud hosting costs go up by $5,000 for every 1,000 new users, and you're adding users at a steady rate, your costs will grow linearly as well. Again, it's very stable state, it's a very steady state. And fifth is a baseline for comparison. Even when you know growth won't be perfectly linear, a linear forecast gives you a simple baseline. And that you can layer in adjustments for seasonality, maybe market changes, or maybe some other factors. But here's the important thing. Linear forecasting assumes that the future will behave like the past, and it'll be the same rate of change, same direction, and not many surprises. And that's a huge assumption, and it's often wrong. So use linear forecasting, if you may, when the situation is very stable and predictable, but always ask yourself this one question: is there any reason to think the pattern will change? So what are the tools and techniques that we often use for linear forecasting? Let me walk you through the practical tools and techniques for doing linear forecasting. Technique number one, simple trend extension. This is what I showed you earlier. Look at your recent data, calculate the average change per period, and extend it forward. Let's say your last four quarters of revenue were $1 million, $1.1 million, $1.2 million, $1.3 million. The change every quarter is what, 100K? So you have 100K plus, 100K plus, 100K plus. So the average rate of change is 100K per quarter, right? So it's easy for you to forecast the next quarter. You go 1.3 million plus 100K, $1.4 million, slam dunk, you're done. You can do this in a spreadsheet in about a minute. It's quick, it's intuitive, and it works for very, very stable situations. Now, an alternative way to do it, a little bit more complex, is a linear regression, a more rigorous version. Instead of just eyeballing the trend, you use stats to find the best fitting line through your data. And you can do that in Excel. You can do this with the line estimator function, or by adding a trend line to a chart. Google Sheets has the same capability, by the way. And all BI tools will have regression built in. So what regression is actually doing is they're finding the values of A and B and what is the minimum, how to minimize the errors. They call it sum of square errors, the differences between your actual data and the line. And then the output is literally telling you, here's your starting point, here's your slope, and here's how well the line will fit your data going forward. That last part, how well the line fits, is very important. It's usually expressed as what is commonly called R square. And an R square of 1 basically means that the line is fitting perfectly. An R square of 0.5 might mean that the line only explains half the variation in your data. And if your R square is low, then the linear forecasting might not be appropriate. So the data is not following a straight line if your R square is like 0.2 or 0.1. The other thing that I've often done is using moving averages to smooth the data out. Sometimes your data might be noisy. 1 month is up, next is down, then up again. It's hard to see the underlying trend. So what happens is when you use a moving average, it smooths out the noise. Instead of looking at each individual month, you are looking at an average of last 3 months or 6 months. And the longer the months you choose, the more smooth the data becomes. But it helps you kind of like gauge the patterns, right? So for example, instead of forecasting based on December alone, you forecast based on the average of October, November, and December. So you know what that does? It reduces the volatility of any single weird month. That's all. And once you have smoothed the data, you can apply linear forecasting to the smooth trend. So you're basically doubling down, right? Now there could be something which is even more simplistic, which is rate-based forecasting. Sometimes it's easier to think in terms of rates rather than with absolute numbers. Say you're forecasting headcount costs and you have 50 employees today and you're hiring, let's say, 2 per month. So each employee, it costs about $10,000 per month, let's say. So in month 1, you have 50 employees times 10K, you're spending $500,000. In month 2, it's 52 times 10K, 520,000. Then month 3 is 54, I guess, 540K. This is still linear, right? And you're adding 20,000 per month, but you have built it up from underlying drivers. And that makes it easier to explain and easier to adjust, because now you have two drivers. You have the headcount and you have the cost. And what is driving the total amount. So there are some common mistakes that people make in linear forecasting. So let me share you some of the common mistakes. Mistake number 1 is extending the line a little bit too far. Linear trends, they don't last forever. A company growing by 100K per quarter will eventually hit a ceiling. Market saturation, competition, capacity constraints. The further out you extend a linear forecast, the less reliable it becomes. I'm comfortable with linear forecast for a quarter maybe, or worst case at 2 quarters, but beyond that, I'm going to start questioning the assumptions. Mistake number 2 is ignoring the fit. Just because you can draw a line through data doesn't mean that the line will fit well. If your actual results are bouncing all over the place and your line goes through the middle, that is not a good forecast. That is wishful thinking. Always check how well your linear model explains the historical data. If it doesn't fit the past well, it won't predict the future well. Mistake number 3, using too little data. If you have 3 data points and you draw a line, you don't have much confidence. You need enough data to see a real pattern, not just a random fluctuation. I like to have at least 8 to 12 data points before I even trust a linear trend. Generally, you want to have 30 to 35 data points to get a normal distribution, the bell curve. And with monthly data, you definitely need substantially more, if you will. A linear trend is a description. It's not an explanation, by the way. It tells you what happened. It doesn't tell you why it happened. So if you don't understand why revenue grew by 100K per quarter, you cannot know if it will continue. Maybe it grew because you're adding salespeople, or your pricing changed, or something else. Because if you don't know that the trend might break, and you will not be able to answer why the trend broke. That's what I'm trying to say. Always connect your linear forecast to the underlying drivers, and that is what separates a thoughtful forecast from a naive extrapolation. And mistake number 5, what happens when you do all this forecasting is that you ignore the external factors. Your forecast is assuming stability, but the world is not stable. The markets are changing, the competitors enter, the economies are shifting, the regulations are evolving. And before you accept a linear forecast, you must ask the question, so what could disrupt this trend? What are the external factors that are in play that I'm assuming they will stay constant for the next 6 months? If there's a recession coming, or a new competitor launching, or a major customer at risk, your linear forecast will likely be wrong. So when do you move? When do you decide to move beyond linear forecasting? Let me talk about how to know when your linear forecasting is not enough. Signal number 1, if you're doing regression, if your R-square is low, if the linear model only explains like 40, 50, even 60% of the variation in your data, something else is going on. The variation is just way too much, too noisy. The relationship is not linear. So think twice before you use linear tools. If your residuals are showing a pattern, residuals are the differences between the actual and the predicted sales. In a good linear model, the residuals have to be random, and sometimes positive, sometimes negative, but there should be no pattern. If your residuals are curving, negative at the start, positive in the middle, negative at the end, that's a sign that the relationship is curved and it's not straight. You need a different type of model to be able to address that. Signal number 3, you're forecasting growth. You're not forecasting the levels of growth. When companies grow, they often grow by a percentage, not a fixed amount. 10% growth on $1 million is 100K, but 10% growth on $2 million is 200K. That is not linear, that's exponential at that point. So if your growth rate is constant, but your growth amount is increasing, linear forecasting will underestimate your future. Now, the other thing that you need to also consider is repeating patterns. If revenue is always high in Q4 and low in Q1, year after year, then there's a seasonality component that is coming into the mix. A straight line will not necessarily capture that. Make sure that you're also forecasting within certain natural limits. Market share cannot exceed 100%. Customers count cannot go negative. If your linear forecast implies impossible outcomes, you need a different approach. And when you see these signals, like I highlighted before, then you might want to consider other types of forecasting methods, non-linear models, seasonal adjustments, REMAs, other techniques, or a mix of them. Even human judgment at that point. But even then, linear forecasting, it still remains valuable as a baseline tool. Start with a straight line, then ask, how is reality? How is reality different from the simple assumption? It really surfaces a lot of questions at that point. Let me share with you how I actually use linear forecasting in my work as a CFO. You know what I do? I use it first for very quick sanity checks. When someone presents a forecast, I often do a very quick linear extrapolation in my head or a piece of paper. If they're forecasting 40% growth, but the linear trend suggests 15%, I want to understand why and what is changing. Second, I use a lot of it for expense forecasting, honestly. Many expenses, they grow linearly, headcount cost, rent, certain vendor contracts. Linear forecasting actually works a lot better for those line items in revenue. Third, I use it a lot for capacity planning. If each sales rep, they're producing 500K in revenue and I'm adding 2 reps per quarter, I can forecast the revenue contribution linearly and I'm generally in the ballpark at that point. Fourth, I use it as a baseline for scenarios. My base case forecast often starts with a linear extrapolation of current trends. Then I layer in assumptions about what might change. New products might come in, market shifts might happen, and new investments will flood the market. The linear baseline makes the impact of those assumptions viable. I also use it to challenge leadership or to challenge optimistic forecasts. When sales presents a hockey stick projection, I ask, what does a linear trend show? If the linear says $10 million and they're forecasting 15 million, I'm not saying they're wrong. I just simply want to understand what is driving that extra $5 million. And I also use it for communication. Linear forecasts are really easy to explain, by the way. We have been growing by 100K per quarter, so we expect that to continue. Okay, but if someone says we will grow at 300K, given the historical is 100K per quarter, we need to understand why. Communication becomes very easy. So what are the key takeaways that we can take from this session on linear forecasting? And there are 3 things that I think you ought to remember. Linear forecasting, by the way, it assumes constant change. You add the same amount and you add the same amount each period, and it's the simplest forecasting approach. And it works well for very stable, for very mature situations and short-term horizons. Number 2, you master the tools, the simple trend extension, linear regression, moving averages, and rate-based builds. We talked about the drivers, multiple drivers. Know how to check if your linear model actually fits the data. If it doesn't fit the data, well, then be careful about it. You don't have to trust it entirely. And number 3, linear forecasting is simply a foundation. It's not a ceiling. It's where you start, not where you stop. Learn to recognize when linear is not enough. If the growth is exponential, when patterns are seasonal and the world is changing, then your linear modeling thought structure, your schematic is not going to work. I will also talk about nonlinear forecasting in a separate video because we know that straight line is not enough. Take care. Cheers. I hope this was helpful. But again, don't let go of it. Hang on to it. But this is one of the tools in your belt, in your arsenal. Take care. Bye-bye.